We're now on the verge of witnessing a financial apocalypse that could make the Great Depression look like a mere hiccup. The world's economy is already on shaky ground, with rising debts, falling currencies, and political instability. This time bomb is ticking away in the shadowy world of derivatives, where banks and financial institutions have been playing a dangerous game of Russian roulette with our money. So join us as we unravel the truth about this ticking time bomb. We've detailed how it was created, how it was grown to become the most dangerous financial instrument in the world right now, and just why it's set to explode with catastrophic consequences for us all. So let's dive right in. On the morning of Friday, March 10th, the sun shone brightly over the Silicon Valley skyline, casting a golden hue on the towering buildings that house the region's tech giants. But in the heart of the financial district, a dark cloud loomed over Silicon Valley Bank, a once mighty institution that had played a pivotal role in fueling the growth of the tech industry. For years, SVB has been known for its innovative lending practices and its close ties to the startup community. It was a bank that prided itself on being different, on breaking away from the stodgy traditions of Wall Street and embracing the fast-paced, risk-taking culture of Silicon Valley. But on this fateful day, the innovative spirit had led the bank down a dangerous path. As news of SVB's collapse spread, it sent shockwaves through the financial world. The bank's assets totaled $78.3 billion, making it the 16th largest bank in the country. Yet despite its size, SVB was not considered a systematically important financial institution, or SFI, by regulators, meaning that it was not subject to the stricter oversight and capital requirements imposed on larger banks. The reason for this distinction lay in the bank's exposure to derivatives, which are complex financial instruments that allow investors to bet on the future value of assets. Although SVB's size technically fell below the SIFI threshold, its collapse was still significant. The bank's exposure to derivatives, which are complex financial instruments that allow investors to bet on the future value of assets, was a major contributing factor to its downfall. Derivatives are known for their complexity and interconnectivity, making them high-stakes games that only the most sophisticated players can navigate. JP Morgan, the largest U.S. derivatives bank, holds a staggering $55.387 trillion in derivatives, making SVB's $27.7 billion holdings seem like pocket change in comparison. However, the interconnected nature of the derivatives market means that a problem at one institution can quickly spread to others, leading to a catastrophic collapse. SVB's failure is now on record as the second largest in U.S. history, following Washington Mutual in 2008. It has now left many Americans wondering whether the regulatory framework and measures that were put in place after the global financial crisis of 2008 are indeed robust enough to prevent another collapse as is now imminent. Derivatives as financial weapons of mass destruction. In 2002, when Warren Buffett first called derivatives financial weapons of mass destruction, it was already clear that they posed a significant risk to the financial system. But in the years since then, the problem has only grown worse. Today, the size of the derivatives market is staggering, with estimates putting it at anywhere from $600 trillion to over $1 quadrillion. To put that in perspective, the entire global GDP in 2022 was around $87 trillion. The notional value of the derivatives market is therefore many times larger than the entire world economy. But despite the enormous size of the market, most of the trading is done privately, which means that regulators have very little insight into what's happening. Now, this lack of transparency not only makes it difficult to assess the risks posed by derivatives, but also makes it nearly impossible to prevent market abuses or detect fraud. And while derivatives come in many forms, the largest and riskiest category today is interest rate products. This includes things like interest rate swaps, which allow two parties to exchange fixed and floating interest rate payments. And because interest rates are so fundamental to the functioning of the global economy, any disruption in this market could have serious consequences. When it comes to who's holding all these derivatives, it's not surprising that the biggest banks are also the biggest players in the market. As of the third quarter of 2022, JP Morgan Chase, Goldman Sachs, Citibank, and Bank of America held the majority of derivatives held by U.S. national and state commercial banks and savings associations. Together, these four banks held around $173 trillion in notional value of derivatives, or about 88.6% of the total held by insured U.S. banks. And here's one shocking fact you probably didn't know about derivatives. You see, originally, derivatives were created as a tool to help farmers and other producers manage the risk of dramatic changes in the markets for raw materials. For instance, a farmer could use a derivative to lock in a price for his crop in advance so that he wouldn't be exposed to sudden drops in the market. This was a smart move for farmers who needed stability in their income. However, in recent years, derivatives have morphed into something else entirely. They've become powerful vehicles for leveraged speculation, which is essentially borrowing money to gamble on the direction of the market. It's like going to a casino, except the bets are much bigger and the stakes are much higher. At their core, derivatives have become more like bets where a player hedges against a variety of changes in market conditions, such as interest rates, exchange rates, defaults, and so on. These bets are sold as insurance against risk, which is passed off to the counterparty to the bet. But the risk is still there, and if the counterparty can't pay, both parties lose. In some cases, the government may be forced to step in and cover the losses. One of the problems with derivatives is that players can bet on an asset without actually owning it. This has allowed derivative bets to grow many times the global GDP, which is a staggering amount. The temptation is to burn down the barn to get the insurance, so to speak. Interestingly, financial entities that take these bets typically hedge by betting both ways, and they are highly interconnected. If counterparties don't get paid, they can't pay their counterparties, and the whole system can go down very quickly. This is what is known as the domino effect, and it poses a systemic risk to the financial system as a whole. It's a bit like a house of cards. If one card falls, the whole thing could come tumbling down. But despite all of its evident risk, derivatives have remained an essential part of modern finance, with many investors using them to manage risk and generate returns. Derivatives are risks hidden in the shadows. As it stands, derivatives have become a major player in the global financial system, and they're largely a creation of the shadow banking system. This system is made up of financial intermediaries that operate outside of the traditional banking system and are not subject to the same regulatory oversight. The shadow banking system is known for its ability to facilitate the creation of credit globally, but it has also been the source of financial instability in the past. One of the reasons for this is that the system includes unregulated activities by regulated institutions, which can create a sort of regulatory arbitrage, where institutions can take advantage of loopholes in the system to engage in risky behavior. A popular example of an unregulated activity within the shadow banking system is the repo market. This market is like a pawn shop for large institutional investors with more than $250,000 to deposit. It allows these lenders, including pension funds and the U.S. Treasury, to park their money and earn a bit of interest. But here's the catch. The safety of the repo market is not insured by the FDIC like traditional bank deposits are. Instead, it is insured by sound collateral posted by the borrowers, preferably in the form of federal securities. This means that if the borrower defaults on the loan, the lender can seize the collateral to recover the funds. So while the repo market continues to be a safe place to park your money and earn interest, it is not without risks. In fact, during the financial crisis of 2008, the repo market was one of the areas of the financial system that experienced significant stress, leading to concerns about the stability of the entire system. The $80 trillion in foreign exchange derivatives that are about to reset are like a ticking time bomb in the financial world. These derivatives are like a financial juggling act, where banks try to balance their books by offsetting risks from one market to another. The problem is that these derivatives are often undocumented or underdocumented in bank reports, making them difficult to track and regulate. To make matters worse, interest rate derivatives are particularly vulnerable in today's high interest rate environment. The surge in interest rates from March 2022 to February 2023 has been unprecedented, with the prime rate jumping from 3.5% to 7.75%. This sudden surge in rates has caught many investors and banks off guard and could trigger a wave of defaults and bankruptcies. As several market analysts have already pointed out, an interest rate shock could have severe consequences for the global economy. It could trigger a cascade of bankruptcies, leading to a severe economic downturn. This is not just a theoretical concern. We've seen similar scenarios play out in the past, most notably during the 2008 financial crisis. The U.S. corporate contracts due to reset this year alone represent a $1 trillion liability, and this figure is set to increase over the next few years. As these contracts reset, many companies may find themselves struggling to repay their debts, leading to a wave of defaults and bankruptcies. In the end, what we're looking at is a potential disaster waiting to happen. The financial system is incredibly complex and interconnected, and the failure of one bank or one market can have a ripple effect that spreads far and wide. Now, a few bankrupted banks are manageable, but the real danger lies in the massive derivatives market. An interest rate shock could take down the entire global economy. Our current financial system is fragile and volatile. It's highly vulnerable to systemic shocks, and a small disruption in one part of the system could have a spiral effect that'll spread throughout the entire economy. And should this 1 quadrillion time bomb explode, the American and global economy could get submerged in the worst recession we've ever witnessed.